Hey, what's up, traders? Today is Monday, September 28th, 2015. This is Trader Tim from E-mini Mind bringing you another Monday market analysis. The first thing you probably noticed this morning or yesterday evening, logging into your Thinkorswim platform, if you're using Thinkorswim, is the color scheme and kind of look and feel was upgraded a little bit. Now you notice mine probably looks a little bit different than the way yours looked originally, and if you want to kind of revert back to some of the colors and elements that were in the previous version for so many years, you go up to Setup and then Application Settings, and then if you come down to Look and Feel, I changed mine from dark to Old School Toss, and I changed the font size. I changed the spacing from roomy to normal, and that kind of gave me the look now that I have here. That's a little bit more like the old look and feel. Then the other thing that changed, or that I added to my chart, if I come up here to the quick time frame drop down, there were a number of time frames that were already compiled here, but I wanted to add this 512 to the list so I can just quickly flip back and forth. So if you go to Customize List and then Add Time Frame, you can change it to tick, and then I just go the most days in the list and then drop it down to 512 and hit Add, and that will add 512 to the bottom of the list. So those are the two adjustments that I made to kind of make my charts a little bit more familiar to my eyes, I guess, is the idea behind that. So, that being said, let's take a look at what's going on in the markets. I wanted to actually, let's start with the euro today, because there was a great example of a good trade that failed and broke through the 61.8 and got me stopped out. So this morning we were coming down in not necessarily the cleanest series of moves, but right around 8 o'clock or so Central Time, we did form a low that was breached with this swing high. So at the time, it's always easy to go back on the day knowing what happened and kind of see things in hindsight. But even though we know what happened, let's back up a little bit and we'll take this in real time. So the market was coming down, and we would put in a low, and then we made just a brief high. But you'll notice that the Heikin-Ashi, the candle changed color. Then we drifted down again and formed a new low. And we formed a lower high, formed another low, and at this point, we just keep doing that all day. But what is the catalyst, if you will, or the kind of red flag that we might be getting a setup coming, is when we break the prior swing high. So we broke, and then the first thing that, I guess the next thing, once you identify the break of the prior swing high and the established low, is to draw the Fibonacci retracement from lows to highs. And as we do that, see if I can get in here, from lows to highs, then the next candle forms, goes a little bit higher. Actually, I'm kind of tucked in the corner, so I'm just going to move over a little bit. But so you keep drawing from lows to highs until, so we've got the break, so we draw from low to high, and that gives us our potential 50% retracement. Let's say we kept going higher. As the next candle would form, I would just redraw my retracement from lows to whatever the highs were, and if we went a little bit higher still, I draw from lows to the next high. But in this case, we stopped right about 1183s, and we started to pull back. Everything, looks great. Put your order in just one pip in front of the 61.8. Let's see if I can get to some cleaner area. So put the putting the entry one pip in front of the 50. so 73s, and then putting a stop 2 pips below the 61.8 at 67s makes for a basically picture perfect trade setup. And in this case, we drifted down lower, we broke the 61.8. The trade ended up reversing and going in our favor, but that's a great example of, a losing trade that is just part of the subset of, hundreds and hundreds of trades that we make every year. So nothing wrong with the trade. It was a great setup. More oftentimes than not, the setup completes itself without breaking the 61.8, without going 2 pips below the 61.8, with getting filled 1 pip in front of the 50 and trading, at least to the negative 23, if not further. And so by kind of understanding that this is just one trade of many, there's no need to really be upset about it, to feel frustrated, to knock yourself, to feel like you did anything wrong. It's just part of trading. So I just kind of wanted to highlight on that because a lot of times we talk about winning trades in different elements of the setups, and it's kind of easy to go through and pick out setups that worked. It's harder to go through and kind of identify after the fact the setups that at the time look like good setups but then ended up failing. So that's a good example of a good setup, a great trade that just didn't work out. So let's move over to the ES. And now on the ES, the short is taking us lower. So from highs to lows, we rallied up into 1982s, and then once we came up into the short, I immediately drew the opposing long to see if we end up holding, and indeed we did. So 1911s up to 1982s, we went back and forth for a little while, and today we broke the 61.8. So the target below us is all the way down at 1760s on the S&P. And if we go, let's just go out to a weekly chart. And so you can see, a couple things would need to happen in order for us to get to 1760s. And, this would seem pretty straightforward as we look at the markets after hours when things are still. But in order to get to 1760s, we would first need to break the swing low of 1830s, and then break the swing low of we'll just call it 1810s to make it a round number. And even, that 1800 level would be a very big level with some gravity to it, if you will, to kind of act as a magnet. So, in the meantime, if we know that 1760s is kind of the target down here, at least the potential target, and we have these swing lows in the mix that, once they break, we would expect some follow through, or that's what we would like to see in order to get that move lower. If we break this swing low at 1830s and then immediately turn around and rally and start moving higher, well, now that's a sign that, hey, there's buyers, there's support stepping in at lows. And if we're moving higher from a breach of lows, that's telling us that the bulls have the upper hand and they're pushing the market higher. So those two levels, 1830s and 1810s, are going to be important levels to watch how the market acts at those points. So if we go back to a daily chart, today was a little bit tricky because of the way the market responded on the open. So we basically opened up at the 50% retracement, looking for a long to take us back up to 1982s was certainly a valid move. But if we look at the open, I've just got trading hours only on here, so it's a little bit cleaner. You can see we drifted lower right off the open. And upon doing that, upon drifting lower, if I go back, see if I can get it in my window, I'm going to zoom out one more. Upon drifting lower on the open, we broke the prior swing low that, if we look at the daily chart, was the significant low, other than the major low back on August 24th. So that was a very significant break this morning, just within, really the first 45 minutes or so. And so, with that in mind, that we broke the swing low, looking for a short, looking for that continued selling now that we broke the swing low, looking for kind of some momentum at that point is kind of the next step from there. At this point in the morning, the market 1902s was the short that I had, the order that I had sitting out, and we only made it up to 1901.50s. So not a big deal. We just zoom into the 512 tick chart and come back to the morning here, and I'll change it to a Heikin-Ashi just to keep things congruent with my trading philosophy. And you'll notice that we broke the swing low, but we did not get any sort of retracement back up into a 50. And so that's why it was a little bit difficult, or very difficult, to get into the move lower on this particular morning. You're not going to get them all, and that's certainly okay. You'll notice that we kind of went into an extension right off the low, and when we do that, it is kind of a sign that yes, there's momentum to the downside, but if you're going to be at this point trying to short lows, you end up getting into this type of situation where you try to get short at lows because you feel like, well, there's some momentum that has been showing its hand, if you will, and I feel like the market's going to go lower, but when you start shorting lows at this point, you'll notice the 61.8 is right here, that daily long, you get these little breaks, little fake outs that, yes, they end up going in your original direction that you wanted the trade to go, but typically they can shake you out before you get in them. And now in this case, placing your stop 2 ticks outside of or rounding and adding a tick outside of the 50 would be right on the high point, if you will. So 90.25s would have been, the stop placement. Let me get back to where I was. So because we're at 89.97s, rounding up to 90s and adding a tick, so 90.25s, that ends up being the high of the fake out, if you will. So as it is kind of referred to, being stopped out to the tick, is that scenario where you get into a trade, but you're shorting at lows or you're getting long at highs, and that's enough to, you're at a point where there are buyers at lows and there are sellers at highs, even for just a short time period, and then you can get kicked out and the trade turns around and goes your favor again. So as we get into the middle of the day here, that was about 10:30, getting into the lunchtime session, I definitely start to back off my trading and not place as many new trades, just because the momentum tends to stall, and you'll notice, it did just that. It kind of started moving sideways. So, you can come back out to the 15 and draw the next move, but today just wasn't having it, and the market just drifted lower. Without us, and that's okay. You're not going to catch every move. Every day is not going to be a home run, and it's not really supposed to be. I guess it's just kind of no harm, no foul. I guess on a day like today, where you're putting orders out there, you're actively involved in the markets, and to not get filled and to not force things either. You could take your order and just drag it in if the market comes up close to your entry, and if you got a limit order sitting out in your trade ladder. But that's just a bad habit to get into, because then you end up dragging orders in, get filled, and the market comes back up and hits your hit your original entry, but now since you dragged your order in and you're in deeper than you would have originally, now you get stopped out because your stop is closer. So anyways, that's kind of what I was looking at in today's price action and today's trading on the ES and the Euro. So nothing really to write home about today, but now that we broke the short, we can remove the long drawing and take the long from, or take the high to low, and now you start to see, okay, 1940s kind of lines up with these previous lows, so maybe we get like a little dragonfly, or a spinning top formation like this down here. Maybe there's a little bit of a reversal, takes us up to 1940s, and then we push lower again. Maybe we have another couple days of big body candles taking us to the downside, but at least now we've got some lines in the sand. We've got the major low at 1831s back here. 1830s we'll call it, just because I'm on trading hours only. And then we've got a potential for a rally, but keeping in mind, if we're going to take 15-minute longs at this point, we're taking the longs into a bigger short. So if we have a 15-minute long that pulls back and then trades up to its target, and then we take the next one that pulls back and trades up to its target, when we get a target that lines up with the 50% short, we don't want to be greedy at that point. Take your profit on the long and then get out, watch for that 15-minute break to the downside, and then start taking your 15-minute shorts as we start trending lower. So that's kind of the thought process here for today, and I hope you got a lot out of that. I know a lot of people have been saying that the kind of trade breakdown analysis videos have been most helpful. So keep your comments coming. I am planning to send out a little survey in the next week or so, just trying to find out more of what it is that you get the most out of from the blog, what's not that effective for you, so that I can be doing more of what's working and what's helping, and then less of what's not. So keep an eye on that in your email inbox, and as always, feel free to shoot me an email, tim@eminimind.com. Suggestions, comments, criticisms, anything you got, I'm more than happy to chat and hear what you have to say, and if there's anything I can do to help, I'm more than happy to. So thanks so much for watching, and we'll talk to you next week.